Well, hello and welcome to this Moneycontrol live stream. It's Thursday morning and you're watching Morning Trade with me, Nandita Khemka. Over the next 30 minutes, we'll be talking about the Fed's rate decision, the cues for trade and the stocks to watch out for in today's session. And of course, if you have any stock-related queries, send them in to us on our YouTube feed and we will have them addressed by our technical expert on the show. But before we get on to all that, let's take a look at the top headlines at this hour. U.S. stocks slip even after a dovish hike by the U.S. Federal Reserve as contagion fears return to haunt investors. The central bank hikes rates by 25 basis points on expected lines. Jerome Powell says a pause is likely but maintains that inflation remains stubborn and says it's too early to cut rates. Asian markets edge lower, tracking weak cues from Wall Street. The Japanese market remains shut for a holiday. The SGX Nifty, meanwhile, suggests a mildly weak start for the Indian market. Oil slides further, dropping 4% overnight. Brent crude plunges below $72 a barrel as the Fed's most recent rate hike fuels fresh concerns over economic growth and energy demand. Oil prices, in fact, have dropped 4% overnight. Titan delivers a largely inline set of numbers in the fourth quarter. However, margins come in slightly below estimates. In key earnings today, we'll be tracking Dabur, Hiromoto, as well as HDFC, which are all set to report their fourth quarter earnings today. And World Bank picks former MasterCard CEO Ajay Banga as the president. The Indian origin development leader will take over the reins from David Malpass starting the 2nd of June. Well, with that, let's straight go across to the top story. The central bank, Fed, has raised rates by 25 basis points on expected lines, and Chairman Jerome Powell has hinted that this could be very well the end of the rate hike cycle. Let's listen in to what he had to say at the press conference after the announcement of the rate hike.
Inflation remains too high, and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight.
Well, let's now go across to Mark Matthews of Bank Julius Baer to discuss what the Fed rate hike and the implications would be going forward. Good morning, Mark. Good to have you on the show. Well, a 25 basis point rate hike on expected lines. In fact, something that the markets wanted to hear. It's the end of in fact, the Fed chairman has signaled an end to the rate hike cycle. But, clearly it's the contagion fears in the banking industry that have weighed in on the markets. We saw Wall Street slipping in trade yesterday. What are your own thoughts on what the Fed has done and what it has signaled for the future rate path?
I agree that it is the last rate hike of this cycle. They've raised 5 percentage points from last March, which is a lot. They're back to where we were in 2007 for the Fed funds rate. And we think that inflation is going to continue to come down. So it is the last rate hike. But what Chairman Powell did say in his statement was that with inflation coming down not so quickly, that's the way the Fed sees it, it wouldn't be appropriate to cut rates for some time. And that is the conundrum that the banks face because their deposits are competing against money market funds that now yield 4%. And a bank deposit in the U.S. yields about 0.5%. So what I would say is that there still is the risk of contagion because a lot of the regional banks cater to wealthy clients who would understand that they could move their money to a money market fund, and they might have quite a lot of money in excess of the $250,000 that's federally guaranteed in a deposit at a regional bank. And so, as long as these interest rates do stay at these high levels, the banks will be under pressure. And if I had to put a timeline on that, I'd say probably about 6 months before we might start to think about interest rates coming down.
Right. We saw oil also tumble quite a bit over the last two sessions. The oil markets seem to be penciling in a deeper recession vis-a-vis what the stock markets are anticipating. What are your own thoughts? Do you think chances of a soft landing are receding as we are witnessing quite a few banks, on the brink of collapse? Yesterday, we saw Pacwest shares slump somewhere around 50%. And in fact, reports suggest that they are in fact looking for options for sale. What are your own thoughts when it comes to the US economy going forward?
Well, let's put it in context. Pacwest Bancorp has $44 billion in assets, which makes it about a fifth the size of Silicon Valley Bank. It's not really a big bank. It specializes in wealthy people in Beverly Hills. And so what I would say is that that kind of bank will remain under pressure, but does it become systemic if it's that kind of fairly small bank catering to wealthy people? I don't think so. It would be when you'd see a big regional bank start to witness very big deposits and a collapse in its share price of the same magnitude. And we haven't seen that yet. So I wouldn't worry too much about Pacwest Bank. I think it's not big enough to be systemically important.
Right. But do you feel there are chances that more such banks may go belly up? There are chances of more skeletons tumbling out of the closet, given the fact that the rates will remain elevated, which is, I think, at the highest level in 16, 17 years for quite some time now. Do you think the Fed will actually be compelled to cut rates by the end of the year? Because, the Fed has, in fact, ruled out chances of a rate cut this year, right? But do you think the kind of contagion fears that we are witnessing, maybe the Fed could look at cutting rates somewhere around November, December? What would you say?
I'd say that's about the right timeline, because we do think the chance of a recession next year in 2024 has risen to about 50%. And so that's a pretty good chance, therefore, of if you get a recession, you'll surely get rates coming down. But what I wanted to say with those banks is that if it's just contained to, a bank, say, of about $44 billion in assets, and just one of those once in a while, then I don't think we need to worry. And so the issue, just to go back to it, is I believe the big vulnerability would be if a bank caters to wealthy customers. That would be the first thing that would make it vulnerable, because wealthy customers are more likely to have deposits in excess of $250,000, therefore not federally guaranteed, and more likely to be aware of money market funds yielding 4%, and more likely to be kind of financially savvy and recognize the kind of things that we're talking about. Now, if you couple that with an additional weakness, then I think a bank could be in trouble. And the additional weakness would be like a big hole in its balance sheet, as in the case of Silicon Valley Bank, because they bought treasuries when they were yielding 1.5%, or lots of crypto deposits. That was the problem with Signature Bank. And with First Republic, it was jumbo mortgages in the Bay Area where property prices are down 20%. And so, if there's other banks out there that also cater to very wealthy customers, and those customers identify there's something in the bank that's not quite right, those are the ones that are vulnerable. But if it just stays at a level like a Pacwest Bancorp, then I think it's not going to become a systemic problem.
Right. Lastly, Mark, what are your thoughts on the Indian markets? We are somewhere near about those 4-month highs. Do you think the valuations have become pretty expensive, or which is the other emerging market that you would place your bet on currently?
I don't think it's expensive, because it's just gone sideways for well over a year now. So I think India, if memory serves me right, is on about 17 times forward earnings, which is in line with the valuation premium to the emerging markets, which is well deserved because its return on equity is twice as high as emerging markets on average. So I like it. I think it can do well this year. And in terms of other emerging markets, the other ones would be, there's a long list, obviously, but let's just talk about China. And China is having an economic recovery. but the locals don't really seem to believe it's going to last that long. And foreigners seem reluctant to invest there, given all the geopolitical concerns. I personally still like it. I think it can go up, but it wouldn't detract, wouldn't stop me from owning India as well.
Right. Mark, with that, thanks a lot for taking out time and joining in this morning and sharing your thoughts with us. Well, let's get in our technical expert on the show then. Osho, Krishan, who's of Angel One, is joining in this morning to discuss the market technicals and, of course, to get all your stock-related queries answered. Good morning, Osho. Good to have you on the show. Before we come to stock-specific discussion, let's talk about the Nifty. Well, near about the resistance zone of 18,111. But SGX Nifty is hinting at a second day of weakness. What are your own thoughts and what are the support levels that you will be watching out for on the index for today?
Very good morning, Nandita. Thank you for having me in the show. Well, looking at the overall technical chart of Nifty, well, last week has been very interesting week for Nifty, where we have witnessed 17,800 to 18,200 levels of rally. But as of now, from past one day, there has been some kind of consolidation that can be seen on the derivative front. Because as of now, what we are witnessing that 18,000 put writers are having a very strong positions at 18,000 strike rate. And on the higher end, 18,200 is having a very strong support resistance. So from here onwards, we can expect some consolidation or sideways movement in the benchmark index. But overall, the broader market is looking very positive, because even though if Nifty sees some kind of cool off or profit booking after the 1 week rally from 17,700 to 18,200 levels, but broader market is looking very promising as of now. But for Nifty, 18,000 should be acting as a very strong support, and till it sustains above 18,000 psychological mark, one should stay aggressive or bullish in our market. And even on the downside, 17,900 and 18,000 is the strong support zone for Nifty, while on the higher end, 18,200 is a very strong resistance. And until we surpass 18,200 in a very decisive manner, the market are likely to consolidate in this zone.
Right. Let's also talk about the top brokerage call of today. You know, Titan reported its numbers yesterday. It was a pretty inline set of numbers, even though margins were a tad bit disappointing. Let's look at what the brokerages are saying about the stock post its earnings. Goldman Sachs has a buy rating on the stock with a target price of 3,175 rupees. In fact, it says that management has reiterated the medium-term growth trajectory of 20%, which is a positive. Moving on to JP Morgan, that has an overweight rating, target price at 3,000 rupees a share. Good Q4 demand and margin narrative are better than what was being feared by the street. That's what JP Morgan is saying. Macquarie, in the meantime, has an outperform rating with the target price of 3,200 rupees per share. It's the Q4 jewelry performance that has raised confidence in FY24. And, assumptions when it comes to the watch and eyewear margins, that's been a little weak, according to Macquarie, and that has driven a 2% cut on FY24, FY25 EPS estimate. Where Morgan Stanley is concerned, it has an overweight rating with a target price of 3,000 rupees, and it says that Q4 is broadly in line with estimates. If you look at Titan, it's up somewhere around 3% on a YTD basis. Would you say that it's time to now accumulate the stock, given the fact that gold demand is also, on the higher side, and it will benefit from that?
See, overall, if I will be seeing it only on the gold demand, then it should have been in the positive trajectory from the time of December month. But recently, we are witnessing some kind of positive movement in Titan from past 2 months. That is, from the month of March, we are witnessing some kind of positive movement in Titan. From the levels of 2350 to 2650, it has seen a very strong upsurge. And as of now, on the technical parameters, it is somewhere about the overbought region. So one should not be very much aggressive as of now. But yes, looking at the overall trajectory and the result outcome, one can expect the upside move to be on a gradual basis. So from here onwards, one can expect an upside of immediate basis 2,800, but that to be on a very gradual basis. Overall, it is on a positive trajectory as of now. 2,500 is to be seen as a very strong support zone, and 2,800 is the first resistance or first target for the buyers. So one should keep these levels in their radar. And the time we witness some kind of profit booking or cool off towards 2550, 2500 levels, then one should definitely accumulate this counter for the immediate target of 2800. So overall, the trajectory is bullish, but because the technical parameters are somewhere around the overbought region, so one should not be very much aggressive in this counter. If it breaches above 2720 levels on a daily closing basis, then one should definitely add this position. Otherwise, wait for some correction towards 2550 levels to accumulate this Titan.
Right, so that's the call on Titan. Let's also talk about Chola Finance. It has got a double upgrade from JP Morgan. In fact, the target price has been upped to 1,020 rupees from 700 rupees a share. It says that it's Q4 print. The Q4 earnings have, in fact, addressed all the concerns that were there on the street. And PAT at 20% is ahead of JP Morgan estimates. If you look at the stock, it is up 20% on a YTD basis. Should one wait for a dip to accumulate this one, or is it time to go all in?
On technical charts, we are witnessing already the counter is in a secular uptrend. It is hovering above all the technical moving averages. So one should definitely look to add this counter at current levels also, but not in a very aggressive manner, but in a staggered manner, because the support or the consolidation of 840 is to be seen as a very strong support. So if there will be any dip towards 840, 850, then one should definitely add in a very aggressive manner. As of now, at 880, 890 levels, one should accumulate this counter in a staggered manner. Overall, the technical charts are looking very optimistic. And from here onwards, one can expect a target of 920 in a very short-term perspective and 980 from medium to long-term perspective.
Right, let's get in some stock-related queries addressed then. The first one is coming in from Satish Kumar, and he has a query on Tata Chemicals. Now, the stock was up somewhere around 2.5% in yesterday's session. Earnings were pretty good, 60% jump in profits, and in fact yesterday it ended at the high point of the day, and it's edging towards its 52-week highs of 1200 or thereabouts. How should one play this one now?
See, overall, the chemical counters were in focus yesterday, but as talking about Tata Chemical has been in a narrow range of approximately 940 to 1100 levels. 1000 levels. So from here onwards, we can expect that counter has the potential to retest the levels of 1000, 1020 in a short-term perspective, because the 200-day SMA is placed around 1020. So that should be acting as a very strong resistance. So until it crosses 1020 in a closing manner, one should look for opportunities to buy on the dips and sell on the rises. But from anything above 1020, we'll be adding very positive outlook in this counter. And from there onwards, one can expect a target of nearly 1080 in short-term perspective.
Right, that's the call on Tata Chemicals. But we also have a query coming in from Girish on GSFC. This stock was up nearly 5% in yesterday's session, and it's literally flirting with its 52-week highs now. Do you think it's time to step into this counter, or one should wait for some kind of a dip to come in and then get into it?
This counter has seen a very steep rally in past 5 to 6 trading sessions. From the levels of 125, it has moved towards 171 levels. So one should definitely look for some cool off or correction in this counter, because the risk and reward at current levels is not favorable. So any dip towards the level of 150 should be attracting buyers again. So one should wait for any correction towards 150. And once it reaches those levels, then one should definitely add a long position in this counter, because even on the technical chart, the counter has entered in the overbought region and has seen a very strong steep surge. So after the steep surge, one should definitely not rule out the factor of profit booking. So one should wait for some decent correction in this counter and then can accumulate for fresh buyings.
Right, before I take up any more queries, I want to get into your thoughts on the IT pack. Cognizant has reported an uninspiring set of numbers. And of course, we saw large cap IT companies like Infosys, TCS handing in not a very good set of numbers in the fourth quarter. However, on the other side, we have had mid-cap IT stocks, companies like Mastech and Persistent handing in fairly good numbers. We also have a query coming in on Persistent Systems. But do you expect this entire IT pack to trade under pressure in today's session, given the fact that the cues coming in from Cognizant aren't very inspiring?
See, overall, the IT pack is still underperformance and it is having some kind of pressure that we can witness from the Nifty IT index only. So Nifty IT index is in a lower lows, lower highs pattern. So until it moves out from those zones, we should not be very much bullish in IT packs. But then again, if we will be talking about some of the mid-cap ITs, then mid-cap ITs are performing very well even for the traders and for the investors. So definitely there is a mixed movement, mixed trades in IT pack, but overall one should wait for a confirmation in the reversal kind of a pattern for the heavyweights, and then only one should start accumulating in a aggressive manner in the IT companies.
Right. Next query is coming in from Prashant Nilanwar, and he wants to know your thoughts on IEX. This stock has been in a steady uptrend over the last 1 month. In fact, even on a YTD basis, I think it has given pretty good returns of somewhere around 10% or thereabouts. Would you advise investors to take a position in this stock for the long term now?
See, IEX has seen a upsurge above 200-day SMA after a very long time. It went down below the 200-day SMA approximately around the month of April in 2022, and currently it has seen an upsurge above 200-day SMA after 1 year of time frame. So from here onwards, one can expect that the downward movement should be halted, and from here onwards, one can expect an upsurge in this counter. But looking at the overall trajectory, it is still in the sideways trajectory. So one should not be very much aggressive. But from here onwards, one can definitely think that the bottom has been made, and any dip or any correction towards 145, 140 levels should be seen as a buying opportunity in this counter. On the higher end, the immediate target should be approximately of 168 to 170. So it is still on a positive trajectory, but one should not be very much aggressive with the higher targets.
Right. Let's also take up a query that's coming in on hotel stocks. Ruchika Bindal has written in, and she wants to know your thoughts on Lemon Tree stock. This stock has actually given returns to the tune of 16.5% in a matter of 1 month. How would you view these hotel stocks on charts? Indian Hotels, Lemon Tree, which one is looking better right now?
See, basically, Indian Hotels has seen a very decent breakout in the past 2 trading sessions, so it is looking very aggressive as of now. But because on the back of which all the hotel industry are looking very positive as of now, specifically for Lemon Tree has seen an upsurge from the levels of 78, and it is currently hovering around 90 levels. So from here onwards, the counter is still having potential to test the levels of 96 on technical chart in a very short-term perspective. But from here onwards, again, one should not rule out the factor of some profit booking or cool off in these counters, because these counters have already entered the overbought region. So one should not be very much aggressive if they are the first time or fresh buying these counters. But if one is having the counter from the lower levels, then they should definitely hold with a stop loss of approximately 86 levels for the upside target of 96 in Lemon Tree.
Right. I also want to get in your thoughts on the aviation stocks. Yesterday, we saw Indigo flying high, gaining somewhere around 5%. SpiceJet was also up 2%, given the news flow surrounding Go First. But, is this the right time to actually get into aviation stocks, given the fact that, there could be some more upside on the basis of all the news flow that is surrounding the aviation industry now?
See, overall, Indigo was having a very positive technical setup, but yesterday's movement was totally dependent on the news flow of the Go First Airlines. So because of which we have seen a very drastic up move in Indigo and SpiceJet. But as of now, if we will be talking about the technical chart of Indigo, then it is hovering at a very strong resistance zone. The resistance zone is approximately at 2170 to 2200 levels. So these are the levels where where we have witnessed supply zone in a very n number of times. Specifically, if I'll be saying, then we have seen 2200 levels as a strong resistance for four times. So one should definitely wait for some kind of cool off in this counter. On the lower end, 2100 and 2080. These are the levels where one should start accumulating this counter. And on the higher end, 2200 is the level where one should definitely try to book their profits. And if it breaches 2200 levels and shows a closing beyond 2200, then one should definitely start adding at a higher levels also.
Right, Osho, before I come to your stock picks, I want to get in your thoughts on two counters, HDFC and Hero MotoCorp. Both these companies will be reporting their fourth quarter earnings today. What are the charts saying about these two counters?
HDFC is looking very consolidated. It is having a very narrow zone, approximately from 27,200 to 2,800 zone. So it is in a consolidation zone on the higher end until it surpasses 2,820 levels. Till that time, we cannot see a fresh accumulation in this counter. So one should definitely look for opportunities on the lower end. 2,720 is the level where one should definitely add positions, and 2,820 is the levels where one should book their profits in HDFC Limited. For Hero Moto has been one of the underperformer from the auto companies, because major of the auto companies like Bajaj, TVS has seen a very drastic upside movement, but Hero Moto has been on a subdued note. But from here onwards, one can expect the rally to continue, because from past 1 month, we are witnessing some kind of upsurge in this counter. And finally, after a very long period of halt, the counter has started moving on the higher end. But on the higher end also, the 2,620 mark is a very strong resistance zone for this counter. So until it crosses 2,620, we are not very much bullish in this counter. So we will be looking for opportunities of buying on the declines and selling on the rise. But once it surpasses the 200-day SMA of 2,620, then from there onwards, we can see a very strong rally in Hero Moto also.
Right. And Osho, before I let you go, any stock recommendations for our viewers this morning?
Yes, there are too many stocks which are looking very positive on the technical chart. So the first one is Concor. Concor is looking very much positive, because after so many days, it has came to the levels of 620. And I am expecting that from here onwards, we can see a decent up rally in Concor. For short-term traders, one can expect a target of 644. And also it is advisable to keep a stop loss of 604 for short-term traders. The second one is from the engineering counter. Praj Industry is looking very positive. Praj Industry has seen a consolidation from past 3 trading session, and from there onwards it is witnessing some kind of buying attraction also. So Praj Industry can be looked to for accumulation at current levels also, for the immediate upside target of 375, and it is advisable to keep a stop loss of approximately 350 for Praj Industry. The third one is from the machinery industry, AIA Engineering. AIA Engineering has seen a very strong reboundation. So from here onwards, one can expect very good rally in this counter. Currently, it is hovering around 2,820, 2,810 levels. So one can try to accumulate at current levels for the upside target of 2,920 to 2,940 levels. While on the downside, we are having a very strong support zone approximately at 2,745 levels. So one should keep a stop loss of 2,745 and can look for the target of 2,920 to 2,940 for short-term perspective.
All right, those are the stock recommendations coming in from Osho for viewers this morning. With that, Osho, thanks a lot for taking out time and joining in this morning and addressing all of your queries as well. Well, with that, we are completely timed out on this edition of Morning Trade. So it's a goodbye from me, but don't go anywhere, because coming up next is Opening Bell.